Storm clouds ahead, you say maybe some for the economy?
Yeah.
This is Jamie Dimon on CNN this week, talking about the economic storm that is now overhead, a storm that he warned us about back in early 2022.
Right now, it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way.
Back in the media this week, Dimon explained why the problems in the economy are far from over, and it has a lot to do with something that happened on the 1st of June 2022. Last year was an extremely unusual year, plagued by war, record inflation, rapid interest rate increases, and a stock market collapse. All while unemployment remained at a record low and consumers continued to spend far in excess of pre-COVID levels, fueled by the trillions of dollars they have in excess cash in their checking accounts. But Dimon sees dark storm clouds circling overhead, and while we cannot predict exactly what the economic weather will look like, we can explore the major factors that have raised the probability of further trouble coming down the road. Jamie Dimon is one of the biggest names in the finance world. He's the CEO of America's largest bank, JP Chase, which is also the 5th largest bank in the world. Dimon has built a personal fortune of about $2 billion through the 9 million shares of JP Morgan that he's acquired since his 17-year term at the top of the company. And he's one of the few people I turn to for learning more about macroeconomics. Not because he's some kind of prophet who can predict the future, but because he has a strong understanding of the key factors which influence the likelihood of good and bad things happening in the economy. Recently, Dimon has been talking a lot about an economic hurricane that the world faces as an aftershock to the COVID pandemic. These storms that we see in the economy are not quick events that come and go all the time. They're more like changes in tides that take place over multiple years, and part one of the change we're currently seeing took place last year in 2022. In his 2022 shareholder letter that was released this week, Dimon spoke about the cocktail of unusual events that we experienced. He said 2022 was not normal economically speaking, and in fact 2022 witnessed several dramatic events. We saw a war in Ukraine begin and rage on throughout the entire year, and that certainly added to the growing inflation pressures which were already building as an after effect of COVID stimulus spending. In fact, inflation got so bad that it reached a 40-year high in the US of 9%, a more than 4-fold increase in the annual rate since 2019. And the unusual acceleration of inflation led to an unusually fast monetary policy response from the Federal Reserve, who beginning in March increased the federal funds rate from 0.1% to over 4% by the end of the year. The stock market collapsed around 20%, with many popular stocks seeing much worse performance. In fact, some very big and recognizable names were in the top 20 worst performing stocks for 2022. Tesla and Meta platforms both down 65%, and PayPal, Carnival, and Warner Bros. Discovery were not too far behind. And to top the year off, the yield curve for US Treasury bonds inverted, a rare circumstance where short-term bonds offer a better return than long-term bonds, an indicator that has predicted a recession in 8 out of the last recessions. But maybe even more strange than the crazy combination of negative events that happened in 2022, as of the start of the second quarter in 2023, the economy is still running pretty well. In the shareholder letter, Dimon said, underlying all of this, consumers have been spending 23% more than pre-COVID-19. Similarly, according to our own analysis, have $1.2 trillion more in excess cash in their checking accounts than before the pandemic. In addition, unemployment is extremely low and wages are going up. This is what makes the current economic circumstance very different from what happened in 2008. Beyond the obvious differences of what is actually causing the economic pain, average consumers are in much better condition than before the global financial crisis. Those who held assets in stock or property markets over the past decade have seen huge amounts of appreciation, and that's going to provide some level of a cushion if there is a significant downturn in the near future, a cushion that didn't exist before the global financial crisis. And even for those who haven't benefited from the strong capital markets in a meaningful way, strong and increasing demand for workers across a variety of fields has been driving wages up across the board. But there are still dark storm clouds overhead, according to Dimon, and if we're to see deteriorating economic conditions over the next 12 months, then it's likely going to have a lot to do with something that happened on the 1st of June 2022. Just before I get to those clips, I do want to quickly talk about the sponsor of today's video, Seeking Alpha. Seeking Alpha is a massive online community of stock pickers, and the premium plan has a ton of awesome features for investors. Expert analysis and news for thousands of different stocks to help you learn the ins and outs of what's going on with companies and the economy. You can import and track your own portfolio, including buy or sell alerts. There are consensus buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. You can screen for stocks using a wide variety of fundamental and technical analysis metrics, access up to 10 years of financial data and company filings, and there's a ton of educational content to improve your skills, including webinars, podcasts, and articles. And best of all, if you use my link down in the description below, you can sign up today for an annual plan for as little as $10 per month, or you can head directly to hamishhotter.com/Seeking Alpha and go try Seeking Alpha out today.
If you don't worry in this business, you're crazy. What are you most worried about right now in this business?
Two things. Well, I think all business. Quantitative tightening, the effect it has on long-term rates, inflation higher for longer, that's kind of the tide going out. But I think this war in Ukraine.
Dimon has two main concerns for the economy in 2023: the effects of the war in Ukraine and quantitative tightening. Quantitative tightening is a type of monetary policy used by the Federal Reserve in order to tighten financial conditions. It's really the second main lever that the Fed can pull to slow the economy after their other lever, which is of course raising of interest rates. Raising the federal funds rate is how the Federal Reserve is able to control the short-term borrowing rates in the United States. The federal funds rate is currently set at 4.65%, and therefore a 30-day US Treasury bill offers you just about the same yield. But the federal funds rate set by the Federal Reserve has less of a direct impact on the long-term borrowing rates, which can be influenced by other factors. So that brings us to quantitative easing and tightening. This is where the Federal Reserve buys and sells treasury bonds or other securities to either push new money into the markets or pull some of it out. The US has experienced over a decade of quantitative easing where the Fed has printed trillions of dollars and purchased treasury bonds and mortgage-backed securities. In his letter, Dimon says in the 2 years after COVID-19, the Fed bought $4.5 trillion of US treasuries and mortgage-backed securities, bringing its total balance sheet to $9 trillion. He goes on to say, we have experienced almost 12 years of quantitative easing, or QE, which drove interest rates down, so much so that the US short-term rates were virtually zero and the 10-year bond rate hit a low of 0.5%. But beginning on the 1st of June 2022, the script has been flipped. Now the Fed is doing quantitative tightening, where they're selling back some of those treasury bonds that they acquired, essentially sucking money out of the financial market. So far, the Fed has sold about $550 billion worth of bonds and is continuing to reduce their balance sheet at a rate of $100 billion per month. This is an element of monetary policy that Dimon believes not enough people are paying attention to. He writes, it should be noted that an inordinate amount of attention is focused on short-term interest rates, which the Fed affects directly, but the Fed does not completely control long-term rates and liquidity, which are influenced by both supply and demand and global investor preferences and sentiment. What Dimon is essentially saying here is that even if the Fed decides to stop raising interest rates, which will stop the increase in short-term borrowing rates, it's entirely possible that long-term bonds or long-term US bonds, for example, will continue to see their yields rise. In fact, given that the Fed is now flooding the market with government bonds and has trillions on their balance sheet to go, it wouldn't be surprising at all if, say, the 10-year government bond continued to see its yield rise. The other major factor that affects long-term interest rates is global investor sentiment.
You think the Fed raises again in May?
Well, there are two rates. One is the short rate. I do not know what they're going to do, and obviously they may not because of financial conditions, but there's also longer rates, and that has a different effect, and that the Fed does not control directly. That's controlled by global investors, sentiment, supply and demand, and that's gotten bad for sovereign debt.
And you might be wondering, why does any of this even matter? Well, the more that long-term borrowing rates rise, the more attractive those investments look to investors, And if those investments look relatively more attractive compared to, say, stock market investments, it's going to lead to money moving out of the stock market and other risky financial assets. But will there be a recession? This is the question that's been hanging over the US since the beginning of 2023. Some might quickly point to the inverted yield curve as proof of a recession coming, but Dimon believes that the indicator may not be as reliable this time as it's been in the past. The yield curve inversion has historically been the most accurate indicator of a recession coming in the near future. The curve is a chart plotting out the current interest rate on US government bonds of varying maturities. Normally, the shorter the maturity, the lower the interest rate, resulting in a yield curve that slopes upwards. But sometimes the curve inverts, and short-term interest rates are higher than long-term interest rates. The explanation for why this is the case is really a story about investor sentiment. If investors are very negative or view the markets very negatively in the short term, then they're more likely to be selling short-term bonds and buying long-term bonds, and the selling of short-term bonds raises their yields, and the buying of long-term bonds lowers those yields, resulting in the curve flipping. The yield curve is also usually represented as a spread between two specific bonds, such as the 2-year and the 10-year government bond, which is called the 10-2 spread. When the 10-2 spread goes negative, it means the curve has inverted. And the last 8 times the spread has gone negative, a recession has quickly followed. And since it's currently negative, it also implies that a recession is coming in the near future. But also, maybe not. Dimon in his letter offered the possibility that this time is different. And I know, that sounds like what every single so-called CNBC expert says right before the exact same thing as the past happens over and over again. But Dimon actually has an interesting point that I think is worth listening to. There's something distinctly different about 2023 than all of the other times that the yield curve has inverted. Quantitative tightening. Remember, the long-term bond rates aren't controlled by the Federal Reserve, but they were driven to rock bottom due to the huge amount of quantitative easing that the Fed did since 2020. So it's entirely possible that the yield curve inversion that we see is the result of QE since 2020 pushing down long rates, and the recent rate hikes are driving up short rates. And of course, this still makes the yield curve negative, but it's been pushed negative for a completely different reason to the past. In the past, the reason why the yield curve inverts is because there is a shift in supply and demand based on investor sentiment. And that might not actually be happening at the moment. And with quantitative tightening now in full force, the yield curve could return to normal without a recession happening at all. Of course, it's also entirely possible that investor sentiment is playing a role in the current negative yield curve, and therefore it will continue to be a recession indicator. But I thought it was an interesting point to recognize that sometimes there are different things happening, and an indicator like the negative yield curve is never something you should rely on for your investment decisions. Remember, no matter how bad inflation or other economic factors may seem at the time, if you're a long-term investor with a long-term view, then what is happening right now will end up just being another speck in the rearview mirror of a growing American and global economy.